The owner of Rose Radios, a small trading business selling a range of electrical equipment, has provided the following information at the 30th of September. The business applies the conservatism principle to the valuation of inventory. So we've got a whole bunch of items there. We've got cash at bank, tax bill owing, vehicles, phone bill owing, and so on. And we've got capital, which at the moment we don't know. So we've been given a series of question marks there. So we also have some additional info. The loan from the GUD money is repayable at $500 per month. The phone bill owing is actually the owner's personal mobile bill for last month. And some of the firm's stock is outdated, with total stock now having an estimated current market value of $31,000, which is different to the figure in the stock ledger there of $34,500. What we've been asked to do is define the following terms and give an example of each from the information provided: current assets and non-current liabilities. Let's have a look. A current asset is an asset that will be turned into cash and or used up by the business within the next 12 months. Looking at the examples there, we've got all those assets in green. However, some of those we assume, based on what's called the going concern principle, which you can look up on another video, we assume that some of these will be held for longer than 12 months. They're called non-current assets. In particular, the computer equipment, the fixtures and fittings, and the vehicles, we actually consider them to last longer than 12 months. It might not be true in reality, but it's just called the going concern principle. Again, you can find out more about that in a different video from chapter 1. So the example we're going to use could be cash, stock, or debtors. We've gone with cash, and we've got 2 marks, so one for defining a current asset and 1 mark for the example. Non-current liabilities, they are obligations of the business that are due for payment after the next 12 months. So let's have a look at all the liabilities. We've got the tax bill owing, we've got creditors, we've got loan to GUD money, we've got mortgage and the phone bill owing. So we've got all those examples there. They're all liabilities. However, let's get rid of the tax bill owing, because the tax office always wants their money within 12 months. So we'll get rid of that one. Creditors, we always assume we're going to pay creditors back within 12 months, so that's not a non-current liability. Phone bill owing is a current liability. However, we were told earlier on that the phone bill actually belongs to the owner. So based on what's called the entity principle, we're going to exclude that from the business's record. It's got nothing to do with the business. So we're not going to consider that, and we can't use it as an example now because we're doing this for the business. So the 2 examples we have are, we're told the loan is repayable at $500 per month, so that must mean it's going to last for many, many years. Or the mortgage, which isn't due until 2019. So the loan at $500 per month would be $6,000. That's per year, so it's going to take over 5 years to pay that back. So we could use either the loan or the mortgage as our examples, and again, 1 mark for the definition and 1 mark for the example.